Hey everybody, Dan here. Welcome back to the channel. So in today's video, we're going to take a look at why it doesn't make sense to put a majority of your money into what we would consider like a standard savings account. So we're going to take a look at things like CPI, which stands for Consumer Price Index. We're going to take a look at things like core inflation, which is the rate and change of cost of goods and services over time. We're going to also take a look at FAANG stocks, fractional shares, and Aristocrat Dividend stocks. So make sure you stay tuned for more. So for those of you who haven't had a savings account for very long, you might think, it's a no-brainer, right? It doesn't make sense that we would put the money into a savings account versus another form to make money because the interest rate that is today is just so low. But that wasn't always the case. Check this out. So yeah, it actually turns out that savings accounts were pretty cool. Back in the 80s and 70s, they were a safe investment. They were a decent yield. I mean, check this out. Back in 1975, it was as high as 14.6%. And then probably during the 80s or so, we were seeing more of like a 7.5%, 8.5%. And, you were thinking, hey, that's a great place to just put your money and feel comfortable about it, and that every year it's gaining a certain amount, and that's safe. So now in today's standards, this just doesn't exist. Things are much different. The rate is much less. So as you can see in today's standard, things are just totally in reverse here. So this is just a list of the average interest rates at major US banks. And, we've got some big names here. We got TD Ameritrade, we've got Citibank, Capital One. And I mean, what's really pulling up the average here is pretty much Citibank and Capital One. Other than that, we're looking at 0.01 to 0.02%. So, I mean, there really is not an advantage here to have something in a savings account. So now what you need to consider is since your savings account is not making basically any money, we need to look at what else is happening in the world that's affecting our money. So if we take a look here, we've got a chart showing inflation rates, and this is taken from December, and it was just announced that the inflation rate currently is sitting at 7%. And now how they take that metric is they look at what's called core inflation, which is the rate and change in the cost of goods and services. But what they fail to tell us and really take into consideration is they say that food and energy are exempt. So that does not report. So this does not report on things like gas, food, and heating. So and the reason why that's not included is because they say that those prices are so volatile that it doesn't make sense to add them in because things could change left or right. This rate is a baseline, but it could be higher. So now let's take a look at kind of what's happening to our money, right? So we need to take into consideration consumer price index, right? So we just looked at how inflation is impacting our money, right? So things are getting more expensive over time. And now we need to look at, okay, what's happening to our savings accounts, but then also looking at the purchasing power, right? So, we want to look at how much things are going up over time, because as time goes on, our dollar gets worth less. So for simplicity's sake, let's take a look at $1,000, and I'm going on the high side here of 0.10% interest rate. I mean, that's being generous. I mean, it was probably much lower than that. So we're looking at $1,104 that you'll gain on that $1,000 a year. So meaning you'll gain $104, right? So there's a website here that's called CPI Inflation Calculator, and what that does is you can put in your dollar amount, and then you can say, hey, what is that dollar amount worth now versus in the future? And it'll say. And so this is just an example I put in. And so we can say, all right, so say you had this $1,000 in your savings account in the start of January 2019. Well, now you'll need $1,107 at the end of December 2021. So you'll need an extra $107 to make that $1,000 the same again. So basically you just wiped out your savings there, if you were just kind of puddling along with just a bet, the standard interest rate and the standard low savings account. So it really does not make sense, guys, to just keep your money, majority of it just sitting in a general savings account, right? So what do you do? What is a good solution? I mean, there's the stock market, there's real estate, there's starting your own business. There's a lot of opportunities, right, to make your own money. But what if, to make a lot of money, I should say, but what is a safer alternative? And so one thing that I've thought of is allocating part of your savings into fractional shares, meaning that you can buy fractional shares of a company. Fractional shares have been around for a really long time. So one example is, if any of you invest in a dividend stock, so you're going to get paid a dividend, right? So that dividend, unless you own millions and millions of shares, even hundreds or thousands, you'll get full shares in returns, but guaranteed you're getting a portion of a share back for you. If you're reinvesting your dividends, now you're reinvesting a partial share, a fractional share. So that's the same idea that I'm thinking here, is that let's take some of the money that you would be putting in your savings account and let's put it into a fractional share. And so I've thought of two solutions that would work as far as where are the best scenarios to put some of your fractional shares. One is FAANG stocks, which I'll talk about in a moment. Those are basically the top tech stocks. And just really quick, and I'm going to go over this of course later, but they have on average over 10 years gained 32% over 10 years. So that is, again, that's pretty good. And then another alternative is Aristocrat Dividend stocks. So those are more of a safer alternative, and I'll talk about those in a minute, but those again are a way for you to invest in they're a dividend stock, so you'll invest in them and then that fractional share will gain a dividend and slowly over time. It might not be much, but at least it's something, right? All right, so what are FAANG stocks, right? So FAANG basically stands for Facebook, which is now Meta, then Apple, Amazon, Netflix, and Google. And so if you take a look here at this chart, you can see that, so this is since 2013 all the way up till the end of last year, 2021. And we could see that basically these FAANG companies have just blown away basically the stock market, just left it in the dust completely. And what I want you to really focus on is the purple line. So that's the S&P 500. And so the S&P 500 is comprised of 500 companies that fit a certain criteria, and it's basically a benchmark for the entire stock market, like how things are performing. So a lot of times people will take a look at like different funds, different mutual funds and stocks, and compare them to the S&P 500 because that is just, it's like, do you own a group of these companies or your individual companies? How at the end of the year, how does it compare? And you can see that, basically the FAANG companies have, over time, this is not, something that is short term, but over time they have just, blown the S&P out of the water. So definitely something to look into. And the other thing that I want us to look at is Aristocrat Dividends. So what does it mean to be an aristocrat, a dividend stock, right? And so basically an aristocrat needs to fit certain criteria, right? So it needs to be in the S&P 500. And what's really cool and what a lot of people like is that, because it's considered stable. And so they have for 25 plus consecutive years increased their dividends. And I mean, so there's a lot of things that have happened, over the course of that time. 2008 housing crisis was one example. So, and yet they're still increasing their dividends. Right now in 2022, there are 65 dividend aristocrats. So those are your companies, just like in this picture here. So you got Coca-Cola, you've got General Dynamics, you've got, just a big mix of stocks, Cat. And so in this chart here, this is a little bit older, so from 2020, but the dividends aristocrats have consecutively beat the S&P 500 as well. Now, another thing to consider is, so in the FAANG stocks, FAANGs do not offer dividends, whereas an aristocrat dividend stock, obviously it's in the name, so they give you a dividend on your shares. So great thing to consider. All right, so then the next question is, right, how much to invest, right? So if you've got this money sitting in your savings account and you're not sure what to do with it, it's making, like we had seen, 0.01%, maybe 0.10 if you're lucky, what should I do? How much of these should I put in these fractional shares? Well, that's a question that you're going to have to really answer on your own and really think about. So there are definitely things to consider, before messing with your savings account, right? So when you have a savings account, you want to make sure that you have an emergency fund, right? So, even though it's not making, a certain amount of percentage, it's very important to at least have, on average, at least what I'm reading is that you want to have at least 6 months worth of expenses saved, right? So stuff happens, it's not worth it to, do risk your savings account. I mean, this is your savings. And then the other thing too, so if you do consider, putting some of your money into fractional shares, that you are theoretically putting your money into, you're not theoretically, actually, you're putting your money into the stock market. So, and by nature, the stock market is variable. So it's going to go up, it's going to go down. This is something where if you're going to invest and put in your money into fractional shares, you want to at least invest this money and think of it like a savings account, right? So if I think of a savings account, I think of, I'm just socking money away, savings. Well, with the same idea with the fractional shares, right, is that I would buy these with the goal of holding them for at least 5 years, at least, and that's on the minimum side, because over time the stock market does well, but short term it's a gamble. So in the next upcoming videos, I'm going to talk about different companies and places to actually start up a brokerage account or something to start trading in these fractional shares. But the idea again behind these are that you're putting just a small amount of your money that you would normally be savings into like some sort of a fractional shares, with the hope that a combination of the savings account and the fractional shares, that you would be beating basically inflation, which is what we saw is on the average low side 7%, but probably more. Rather than going out and outright purchasing, like let's say if we look at a FAANG company like Amazon, so Amazon's trading in the 3,000 range. So rather than going out and buying one share of 3,000, well, now instead with fractional shares, for example, you could go out and put $100 in there. And so say it gains 10%, well, your $100 goes up 10% as well. So it's a nice way to get in at a relatively low price. So yeah, thanks for watching, and I'll be doing some more investment videos in the future. So stay tuned for more and have a great evening. All right, take care.